Hey there, class. It's Phil McDowell, mortgage professor with Mortgage Alliance. Mortgage is Marvelous. I'm going to give you some real tough news today, and it's about a very unfortunate circumstance. It was on the news March 24th, Wednesday, CTV, local news, and it dealt with an individual that 2.5 years ago had made an offer on a condo at London at Heritage Station. At that time, the marketplace supported a value of $420,000. The individual actually got approved through a lender, through Canada Mortgage and Housing, 2.5 years ago. 2.5 years ago, now times are different. CMHC actually did a reevaluation of that particular condo unit that he was buying, and instead of $420,000, they came up with a value of $335,000. And they said, you know that mortgage that we had approved for you before? Can't do that. So there's over $80,000 difference now. And there's no money to meet that gap. And the developer is going to be suing this individual to complete, or for their loss they incur if they have to resell the property. Now, here's the issue with mortgage approvals, be it through a lender alone or a lender in conjunction with a default insurer like CMHC, Genworth, or AIG. When a lender and the insurer says you are approved for a mortgage, it's based on the information that you supply for your mortgage application at the time they give you an approval. So when they say all conditions are met, that means that they're happy with your income, your credit, your down payment, and the property today. If anything changes between today and when you take legal possession and that mortgage money, you may have no mortgage money. And the reason why is they're saying your approval was based on your income. So if you change your job or lose your job for whatever reason, that may end that mortgage approval. Your credit rating, let's say it's 4 months before you take possession of your property and you decide, hey, to have a little extra cash when we move in, I'll just avoid a couple of these credit card bills for now until I move in. Oops, that reduces your credit score because of arrears. That may cancel your mortgage approval. Your down payment, instead of not making some payments, you decide to spend the money and say, listen, I can always use my credit card, my line of credit, for the money I've taken out of that cash that I was going to use for my down payment. Well, if the down payment money is improvable at the time of closing, if it's borrowed, it may change your mortgage application completely. You may be disqualified. And as we've seen with that property at London at Heritage Station, if the value of the property changes, it could result in no mortgage approval. So the moral of the story is an unconditional mortgage approval really means that it's unconditional both ways. They won't change, but you can't change, fault of your own or not. So just be warned, unconditional approvals always have that hook in it. Be wary.